Good morning and welcome to The Street on BNN Bloomberg. I'm Roger Peterson. Thank you very much for joining us. Coming up on the show today, Martin Cobb, Senior Vice President, Equities at Lawrence Steinberg Wealth Management, will be joining us for the hour. In 30 minutes, Randall Bartlett, Deputy Chief Economist at Desjardins, will join us to break down the latest Canadian CPI numbers. And of course, we want to hear from you on First Call. Call us with your questions on global and North American equities. I'll have Martin Cobb answer as many of them as he can at the end of the show. The number to call, 1-855-326-6266. We'll open the phone lines in about 30 minutes. Our email address, firstcall@bellmedia.ca. Now, some of the stories we're tracking for you in the BNN Bloomberg newsroom. Janice Charette has been pegged as the new chief trade negotiator for the upcoming CUSMA review. Charette is a two-time clerk of the Privy Council, High Commissioner to the United Kingdom as well. She was also the top advisor on the transition team that ushered Mark Carney into office. The appointment comes just a day after global investment banker Mark Wiseman took the reins as Canada's next ambassador to the U.S. The pace of home building in Canada continues to slow with no near-term signs of a turnaround. This according to a report by the Canada Mortgage and Housing Corp. The National Housing Agency says the seasonally adjusted annual pace of housing starts declined 15% in January. Housing starts can vary considerably month to month as big projects get started, but the agency's 6-month moving average for annual starts also showed a 3.5% decline. BHP posted earnings for the second half of 2025 at the upper end of analyst expectations. The Australian company's year-long effort to increase copper production and historic metals rally contributed to the results. Earnings from the miners' iron ore business also edged up 4%. Now today, BHP announced a $4.3 billion long-term silver streaming agreement with Wheaton Precious Metals. And now back to our top line story. Over the long weekend, Janice Charette was named Canada's new chief trade negotiator to the U.S., a key appointment ahead of this year's CUSMA review. Let's bring in our guest for the hour, Martin Cobb, Senior Vice President, Equities at Lawrence Steinberg Wealth Management, to get his thoughts on the new hire, I guess. Well, the new old hire, I guess. Charette has been around the government for a while and has quite the track record. Lauren, thanks as always for joining. Or Martin, thanks as always for joining us. You're not Lauren.
Good morning, Roger.
I can tell the two of you apart.
Just.
Thanks for joining us. Initial thoughts on this decision?
She comes with, obviously, a phenomenal pedigree, and it's great news, I think, to have someone like her stepping into this role. I thought it was quite interesting is the splitting of the roles. Previously, the chief negotiator and the ambassador was the same individual, and here we split the role of the ambassador, who can do more of the schmoozing, I guess, and then you have a dedicated trade negotiator. So I think that's a very, very positive step forward in terms of negotiating with our neighbours to the south, but also bringing in an individual like Janice, given her pedigree, given her competencies, etc. I think it's very good news. What will be tricky negotiations, let's face it, they're not going to be easy.
It is a challenge, I think, for both Wiseman and Charette. Now, do you think they can work together in the way that you mentioned? What could possibly be some stumbling blocks for them? Do you think, like sometimes can you get a two-headed monster as opposed to one person in control?
That's a very good question, Roger. And there is definitely the potential for that risk. But really the roles are quite, an ambassadorial role is quite different really than a trade negotiation role. And in some ways, maybe having them two together previously wasn't ideal. So, in terms of, the real getting into the grind of bashing out the trade negotiation, CUSMA coming obviously in July of this year, having someone who is solely focused on that and can kind of, neglect the whole kind of ambassadorial role, which is more as, say, wining and dining. That's maybe a little bit unfair. But in terms of more of the soft, touchy-feely stuff, and she can focus on the actual trade negotiations, I think that's a positive step. And likely the benefits from that outweigh any of the risks of splitting those two roles and having two individuals, because I do think the roles are quite separate.
Oh, the life of an ambassador. Now, I imagine the soft talks are probably starting right now. When do you think it'll start getting a little more serious, or does it feel like they're serious now?
I think it has to get serious now. Obviously, we have negotiations going on with Mexico presently, bilateral negotiations in addition to what will happen later this summer. There's a lot of posturing, and I must admit, I would not like to be one of these individuals trying to discern what is the policies or the plans, for the U.S. administration in terms of going forward. And, so I think it starts now. I mean, it's only a few months away, but the real heavy lifting will get done when we get into to thrashing out, the minutiae of the details and with these individuals. Hopefully we can have more transparency. I've said before, I do think the whole, we have the midterms year here, and we have, talk of affordability being the number one issue on investors' minds in the US, and tariffs are a tax on consumers. And so I'm hoping, although I wouldn't put too much faith in it necessarily, that will help with negotiations coming to something that is a little bit more sensible and recognizing the cost to consumers, cost to US consumers of the current tariffs on a number of Canadian products just don't make any sense.
Do you think Trump is seeing that? I mean, I know some Republicans are concerned about the midterms, and even just that talk about the ambassador, not the ambassador bridge, the Gordie Howe bridge down in the States from Windsor into Detroit being delayed possibly by Trump because he was upset about it. Do you think, and the reaction he got from the governor of Michigan, senators from Michigan, and all these other states, do you think he is hearing that, or is he just blind to it all?
You're asking me to get into the mind of
Absolutely. It's a Tuesday morning after a long weekend. Perfect time for it.
Yeah. The bridge story, Roger. I mean, I was scratching my head. Like, what is the president of the United States of America doing talking about a bridge, between, joining Canada and the US? And then I realized that actually the chap who owns the Ambassador Bridge happened to be in the White House a few days before this decision was made. So you can read into that what you would like. But yes, I do think there's pressure starting to bear. You saw a number of the Republicans voting with the Democrats most recently in terms of trying to take away or not extend the powers of the executive branch in terms of imposing tariffs. So there's rumblings happening. There are Republicans in some swing states, starting to kind of question whether, the policies are sensible. And I think that'll just build more and more over time. Will that, however, be taken as something that is significant in the minds of the president? Who knows?
And you mentioned, of course, we may or may not be negotiating as three. We may be negotiating individual deals with Mexico and the U.S. Canada has that massive delegation going down to Mexico right now. Do you think that will anything will come of that? And what kind of an impact do you think that'll have on any of the talks coming up? Will this again get a bee in the bonnet for Trump?
Yeah, I mean, I think it's 1% of our exports go to Mexico. It's
about I think 56 billion. I think is what it's at right now.
Okay, and obviously a lot of those have to go through the US, which isn't helpful. I think the greatest fear is that Mexico would strike a deal with the US before we struck a deal with them. So I think partly we're trying to head that off, trying to position ourselves to have a good relationship with Mexico. I think we and Mexico both stand for the same kind of free trade, back to the kind of rules, world order, etc., that kind of thing. So I think it's more the concern of if Mexico was to strike something with the US, which was disadvantageous to us ahead of CUSMA negotiations, we would want to be ahead of that. So I think this is a proactive move by the Carney administration to get in front of that. But will anything significant come out of it? It's hard to see.
Okay, we'll leave it at that, Martin, but stick around. Thanks for joining us. Okay. We'll take a look at the markets before the bell. All right, let's see how things are shaping up in the markets. We'll start with U.S. futures, and they are soft over AI tech jitters. You can see more than soft action for the NASDAQ. It's down more than 1% right now as we head into the trading day. Over in Asia, most of the markets were closed for the Lunar New Year. The Nikkei, though, was open, and it was off over soft Japanese data and some profit taking. Heading to Europe, U.S.-Iran talks. Concerns over AI, a heavy European earnings slate have the markets muted. The FTSE, not the NASDAQ, I'm still there. FTSE up about a quarter point. The others are down slightly. And looking at the TSX, of course, closed for the Family Day holiday on Monday, but back on Friday, it surged over 33,000, up 1.87%. And some of the movers from Friday, look at that. Magna International up nearly 19%, almost 20% really. Trisura Group, 11.5%. Vantage Energy going the other way, down 5.5%. And Colliers down 3.4%. Taking a look at the metals now. And everybody's in the red. Gold just below 5,000. Silver dropping off from those highs just a month ago, I guess. Hard to believe. Off another 5.25 right now to 73, below $74. Copper down to 573 right now. And looking at oil, all eyes, of course, are on the U.S.-Iran talks. You can see WCS was 0.68 for yesterday after the long weekend. And then WTI, let's have a look at what it's doing right now. Up still, but 63.5, up 0.97% right now. All right, market narratives are sticking around longer than they used to, and that is reshaping how value growth and mean reversion behave. For more on how investors should be adapting, we're back with our guest for the hour, Martin Cobb of Lawrence Steinberg Wealth Management. And Martin, what are some of the narratives and how are they changing and how are you adjusting to it? All those questions in one.
Yeah. No, I mean, it's something we've seen in all aspects of life, just with social media, the dissemination of information, the forums like Reddit. I remember, was it Pope Francis with his white puffer jacket, his Balenciaga, white puffer jacket, and it went viral. But what I'm kind of seeing increasingly that is in the financial world, and narratives are taking hold. It doesn't matter if the narrative's true or not, because people don't tend to check the truth of narratives.
Never let the facts get in the way of a good story. Exactly,
I think they're, again, looking back at the prior election in the US, there were various claims made, and you hear stories like 1 million people watch this, the video on the claim, and then maybe 30,000 watch the rebuttal in terms of, is the veracity or the truth of that. So we have this kind of, lifestyle nowadays where things just take hold, and regardless of whether they're true or not, stick in the minds of individuals, and there's no exception to that, I think, in terms of investors. So, for example, I hear today that AI is stealing jobs. That's a little bit lazy, if you ask me. If you look at the analysis, from the economists have done some great work on this. There's actually very little evidence that's happened yet. It may happen, but it's the default assumption. And again, we talk about AI is going to kill software. And so that, there's this kind of narratives are taking hold and becoming accepted wisdom. And I think someone once said, conventional wisdom is often not very wise.
And it also gets harder and harder, though, to get the information because AI is now being a part of it. I just went and checked something. I wanted to see how the markets did on Monday and Friday, the TSX, and it came back and told me Friday was great and Monday was down slightly. And it's like the markets were closed on Monday. So, I mean, you're trying to process information still, and now you're trying to process information. You're not sure if it's correct or not.
Yeah, I mean, that's a very good point. I mean, the understanding of how AI works is probabilistic. It hallucinates. I mean, it's actually part of its strength is its ability to hallucinate in some ways, but we have to correct for that errors. And, I use, Gemini or ChatGPT extensively these days in terms of research. And sometimes I question something and it's, oh, you're right. Hang on a sec. It is a little bit worrying. So it's, we are human beings. We like our narratives, our heuristics, our shortcuts. We're looking for something to fit what we already believe. And in addition to AI, then you have all the algorithms, the news feeds that we subscribe to increasingly are reinforcing themselves. So we don't choose to look for information anymore. And you're absolutely right, Roger. We're served up stuff which we take to be true and don't bother, really, because we're a bit lazy, and checking whether it's actually true or not.
So with every risk, there is also an opportunity. What are you doing with all this?
Yes. So the great thing about that is, if there is something, that is, I believe, not likely to be true or even not true, and the market believes it, that can provide, a great opportunity. Benjamin Graham, coined the individual Mr. Market. He comes to your door every single day and he's a manic depressive. And sometimes he's super excited and he's willing to pay high prices for any stocks that you own. And then some days he's really depressed and he's willing to sell you stocks at any price that you're willing to pay. And going back to the narrative points, we tend to believe Mr. Market is accurate. We tend to believe he is rational, whereas history tells you he's not. So I'm looking today and looking at areas of the market, where I feel investors have just, in a kind of complete abandonment of, what I would say is rationality, have just assumed that this is the way the world is. So we can take, opportunities of that. There obviously, we've talked about it in the past, the whole idea of AI eating software, or increasingly information providers, real estate brokers, what's going to be this week? We'll find out, I guess, in terms of that kind of thing. But there are just these opportunities. In the short term, though, you might look a little bit stupid. But in the long term, I do think there's some fairly compelling opportunities to invest, clients' capital.
And with that, and we mentioned that at the top, the value growth, mean reversion. How much have they changed in your eyes?
Yeah, it's something we don't talk about value versus growth anymore. It's because no one admits to being a value investor anymore, because it's not been great for the last 15 years or so. I was schooled on mean reversion, and that's how really Templeton success over the decades was built on the basis that nothing stays good forever and nothing stays bad forever. But the last 15 years has really challenged that, because for the first time in my career, we've seen entities with very high growth, but also very high free cash flow margins. The Microsofts, the Amazons, increasingly free cash flow positive, the Metas, the Alphabets. So you've not had the kind of mean reversion. So value investing needs a little bit of a shakedown, I guess. So the idea that mean reversion over a 5-year view, say that all stocks should be treated equally, is increasingly, I would argue, false. And you have to recognise there are network effects, there are reinforcing of economic moats which didn't exist 20 or 30 years ago. So I would say there's opportunities there, but also recognising that things have changed. John Templeton talked about the four most troublesome words in investing is this time it's different. And he also said that 20% of the time it is different.
All right, we'll have to wrap it up there for now, but we'll be back with Martin Cobb of Lawrence Steinberg Wealth Management to see why the software stocks, AI, and all that are on his radar. Well, software stocks have been under pressure from the AI narrative, but our guest says the markets have gone too far. We're back with Martin Cobb of Lawrence Steinberg Wealth Management to tell us why the sector is on his radar. Martin, they've been taking a hit, they've been getting beat up, but you think it's a little bit unfair?
Yes. I was on Market Call last month with Morella Roger, and someone dialed in and asked a question. And the question I thought struck me as being really quite interesting, because they said, to do with Adobe, which is a stock that we own. And the question was, Adobe's really suffering from AI. And I just kind of scratched my head when I answered the question. I said, is the stock price really suffering, or is the business suffering? Because this is the kind of the differentiation between the two. There is no evidence yet, that the business is suffering from AI, from large language models and the video generation tools, etc. But the stock price has suffered dramatically. And you can see the same across the whole swathe of software companies. If you look at the fundamentals, and we get updates every 13 weeks, there's very little evidence yet that they're hurting these businesses. But the fear is that they are going to over time, and that's why the stock prices. So we've been underweight software for quite some time because we simply couldn't stomach the valuations. And that's both in our global equity product and also within Canada. And today we're starting to nibble away at some of these businesses because the valuations are just so compelling. Yes, there are challenges. Undoubtedly, AI is changing the game to somewhat, but there's a real misunderstanding of how embedded software can be within enterprises, the high costs of moving, the recurring revenue streams. So the truth is somewhere in the middle, but with valuations today in the sector at levels that we've not seen for over a decade in some cases. I think it's a great risk-reward opportunity.
What's giving you the confidence that AI will be incorporated as opposed to replacing software?
Well, a number of things. One stock we talked about recently buying is Constellation Software. So Constellation Software has over 1,000 different kind of businesses within its overall arching group. and they do software for like cemetery planning. So you're sitting running a cemetery somewhere in the world. Are you really going to experiment with AI if the software, does what it says on the tin? I just don't think so. Again, you look at the likes of Adobe. You have this, all this terminology of AI slop. There's lots of ability for people like me to generate AI imagery or AI videos, etc. But you've got these organizations, media organizations serving clients who've got a repository of years, if not decades, of Photoshop, Creative Cloud, entities that have been created. And they are bringing AI into that product. But ultimately, there's just, again, these kind of huge switching costs. So it's not that, AI won't be an impact on these businesses, but a lot of them have great opportunities to embed it in their processes, and they already have the client relationship and the individuals at the customer base. I just don't think experimentation is something they want to get involved in. They want the product to work. They want the ownership of the asset at the end of the day. And I do think these companies are much better positioned than the stock market is discounting today.
Okay, let's talk about some of the ones you're liking. Salesforce, first up.
Yeah, Salesforce. I mean, huge pressures, on that business. It's one we've looked at. We don't own it yet, but the share price, as you can see on the chart there, very much beaten up. The view being that you won't need CRM or customer relationship management software. You'll simply just do it yourself with AI. Again, I feel that's just a little bit misguided because of the cementing of within the enterprises that Salesforce already has. Yes, they'll have to compete. Yes, they'll have to improve their offering and make it more AI capable. But ultimately, they're going to be hard to get out of businesses because how cemented they are. The opportunity set is with them to enable AI rather than to be competed away by it.
Okay, SAP's another one.
Yes, this is the German, software company, a bit like Oracle that you have, here in the US. Started life as database software. ERP, enterprise resource planning software, is their bucket in terms of helping businesses manage their software. So if you think of a manufacturing company, they can have software that goes across the whole suite from management all the way down to the factory floor. Again, how do you get rid of it? It's just, it's just so seamless with the organizations that run on SAP that you just can't pull it out. The costs of doing that, the risks of doing that just seem excessive. Again, I'm not saying there aren't threats. Please hear me on that. But again, the share prices are discounting, those threats being all encompassing and ultimately, taking these companies into oblivion.
Okay, we've got about 30 seconds because we're on a tight schedule. TMX, let me just get your quick thoughts on that.
Yeah, another one, an information provider. There's worries there of AI. Tokenization is going to take away the ability for exchanges or the need for exchanges. I just don't buy it. This is a well-positioned business with huge economic moats. Look at the share price. It's telling you that it's the end of the world.
We'll wrap it up there. Perfect, Martin. Stick around. We're going to be breaking numbers on Stats Canada's January CPI data. That's coming up momentarily. Also, our phone lines will open soon for our first call segment, 1-855-326-6266. Email us, firstcall@bellmedia.ca. Canada has signed a preliminary trade agreement with Mexico. Our Minister of U.S. Trade, Dominic LeBlanc, says Canada and Mexico will work to expand port-to-port trade and will also hold talks on security. Canada sees investment opportunities in the pharmaceutical and agricultural sectors. The delegation is in Mexico till Friday. Sherritt International is reducing operations at its joint venture in Cuba due to fuel supply constraints. Mining operations are expected to pause by the next week or so. This comes after the company received notification that planned fuel deliveries will not be fulfilled and there is no timeline for resumption. Production is continuing at Sherritt's Alberta and Saskatchewan refineries, with inventory expected to last until mid-April. And shares of Warner Brothers and Paramount are up in the pre-market. Warner Brothers is considering reopening talks with the rival Hollywood studio after receiving its most recent amended offer. The offer addresses several concerns, including covering the termination fee to Netflix and to backstop a Warner Brothers debt refinancing. Warner Brothers board has not decided how to respond and still has a binding agreement with Netflix. And a quick look at the U.S. futures, and they're all in the red right now. A little bit of a struggle. Tech stocks putting some pressure there. Right now, the Dow off by 0.15, NASDAQ by 0.84, and the S&P 500 down by 0.39. All right, Stats Canada has just released the latest Canadian CPI data for the month of January, and inflation rose 2.3% on a year-over-year basis, following a 2.4% increase in December. The gasoline price index was the largest contributor to deceleration in headline inflation, with a larger decline in January compared with December. Now, you take out gasoline, CPI rose 3% in January, matching the increase in December. For reaction and some in-depth analysis as he breaks down the numbers as they come in, Randall Bartlett is the Deputy Chief Economist at Desjardins. And Randall, thanks very much for joining us.
Oh, thanks so much for having me.
All right. First reaction, 2.3% year over year, 2.4 over compared to December. In line?
I would say even better than in line, to be honest. There was an expectation that inflation was going to remain unchanged at 2.4% in January, unchanged at the December level, and we saw it came in a tick below consensus. And so I would say when you look under the hood of this, overall, every metric that economists contribute to the consensus survey came in below expectations, and so I would say, overall, at first blush, it seems like a pretty good print for inflation and supportive of the Bank of Canada remaining on hold for the foreseeable future.
And just looking at, of course, the big thing about this over year was the temporary GST HST break. How does that weigh in? Are you surprised at where we stand with that?
I am a little surprised where we stand with that in terms of the overall contribution. I mean, we saw that in January, the price of food purchased at restaurants was up 12.3% year over year. So, this is something we anticipated. It dropped materially in January of last year. So significant decline last year, sort of a mechanical pop this year. But ultimately, it was offset by an even more material drop in gasoline prices on a year-over-year basis. And so really led to a headline print, which was fairly sanguine. And even when you remove food and energy, the impact on that sort of traditional core measure was it came in at 2.4%, down from 2.6% in December. So overall, a pretty good print with prices heading in the right direction.
All right, let's bring Martin into the conversation. Martin?
Yeah, hi, Randall. Tiff Macklem has described his job as being more difficult than usual because of the uncertainty with trade negotiations, etc. I mean, it's only 1 month's data, but do you see anything in this that would perhaps change his view?
I don't see anything that would change his view at this point in time. I think, by removing the retaliatory tariffs, by removing the consumer carbon price back at the beginning of April of last year, this really helped make the Bank of Canada's job a lot easier by keeping inflation relatively close to the bank's 2% target and letting the bank focus more on what's happening in the real economy. And so we saw those 2 cuts back in the fall, really focused on supporting the Canadian economy through the transition of this structural trade shock. And ultimately, the Bank of Canada has more room to provide support if we do get some material negative shock because inflation is relatively close to that 2% target.
Now, it's always good to see inflation going down, but are there any numbers in there that are cause for concern that may have dropped for reasons that we might not like?
Yeah, I mean, I would say overall, things are headed in the right direction. I think we've seen that, broad groups that had been contributing a great deal to inflation in the past few years, things like shelter, are really starting to, which make up a big part of the CPI basket, are continuing to move in the right direction. Whether that's, ownership costs because mortgage interest costs continue to decelerate, or we're seeing that rents overall are decelerating. I would say that big contributing factor to CPI continues to move in the right direction. Overall, we are still seeing more food inflation than we're comfortable with, even when you take out the impact of that GST, HST holiday. Bank of Canada came out with a note on this recently saying a lot of this is being imported into Canada, whether it's a function of U.S. tariffs that we're sort of getting indirectly coming up on our shores here, or supply chain disruptions that are still continuing to impact because because of the trade war that the United States is having. But overall, I would say we're getting a lot of broad balance within the overall inflation basket.
Martin, you want to join
Where
it?
do you sit, Randall, on the interest rate outlook? It seems a little bit more nuanced this year. Maybe, no rate cuts, maybe a rate increase towards the end of the year. Some arguing that we're still behind the curve, or the Bank of Canada is still behind the curve. Where do you sit?
Yeah, I don't think that's necessarily an unreasonable argument to make. I think Governor Macklem has stated his position quite clearly that the Bank of Canada cannot really support the economy when there's a structural shock, like a trade shock coming from the United States. That's really the job of fiscal policy makers in negotiating trade deals, providing support to the economy that'll help reorient the economy toward greater trade diversification, infrastructure investment, that sort of thing. And so that seems to be a view that the governor has some confidence in. But ultimately, if Canada is hit with some shock, severe negative shock, potentially around CUSMA negotiation that's happening, that review into the middle part of this year, ultimately the Bank of Canada, I think, has the room with inflation where it is to provide some transitional support for the Canadian economy, really to get it through some sort of to the other side of some new economic condition and economic relationship with the United States.
And with those potential shocks, I mean, we seem to have absorbed the shocks of the initial tariffs. Would we be able to do the same? Any indicators? Would we be able to do the same with the potential of CUSMA disappearing, or a completely revised CUSMA?
We'll be coming out with a note on this next week with some scenarios around what the potential outlook could be, given different outcomes around the CUSMA joint review. But I mean, Canada's been spared much of the worst of U.S. tariffs. We've seen that we've had exemptions for CUSMA compliant goods. So really, the average effective tariff rate on exports going to the U.S. From Canada is somewhere around just shy of 4%, whereas other countries like China, even Germany, Japan, South Korea facing north of 10%, some approaching 40%. So it's really Canada's really benefited from that exemption for CUSMA compliant goods. If we don't have that going forward, it's really an unknown as to what sort of trade regime, trade deal we could have with the United States, and ultimately the sort of potential bilateral tariffs that we could be facing. And so the risks, we think, are broadly tilted to the downside. But Canada could still end up in a better trade situation than many other countries. All
right, Randall, we've got to wrap it up now. But when that report comes out next week, I'm sure we'll be talking to you then. Thanks, as always, for joining us.
Oh, my pleasure. Thanks so much for having me.
Randall Bartlett is Deputy Chief Economist at Desjardins. Still ahead, today's market drivers with Bloomberg's Divya Balji. And, of course, our phone lines are open. Martin Cobb is taking your questions on global and North American equities. Call us at 1-855-326-6266. Email first call at bellmedia.ca. For a look now at some early market movers, we're joined by Bloomberg's Divya Balji. And Divya, thanks as always for joining us. Hopefully you enjoyed a little bit of a long weekend. We're talking about Massimo. It's soaring on the news that it is being sold.
Yeah, it's not Merger Monday since it's Tuesday, like you mentioned, the long weekend. So it's Deals Tuesday, I guess, is what we're seeing right now. This deal was actually announced by the Financial Times. They had actually announced it earlier on today, saying that Danaher was going to buy Massimo. Massimo is a patient monitoring systems provider and maker. Of course, both companies came out to announce the deal properly a few hours after that. The deal is for $180 per share. Massimo shares have already skyrocketed this morning, up by more than 40% on this news. In terms of the entire enterprise value, you're looking at about $9.9 billion, so about $10 billion. Massimo shares closed at around $7 billion on Friday, so a very good premium if you were to look at it. Seems like a very good deal for Danaher if you think about it. Their last big deal was done during the COVID years where they bought Cytiva for, I believe, over $20 billion. This is the second biggest deal that they've announced. One of the things here I think that people seem to really like is the fact that Danaher is getting in a big way into the patient systems monitoring industry. This industry is currently growing and has about $56 billion in revenue. The experts basically expect this industry to double in revenue or grow by more than double in about 9 years to $137 billion. So a good way to get into that deal. Danaher shares were down slightly on the news, but that's usually expected for an acquirer making such a large acquisition.
All right, and now to episode 3625 of the Warner Brothers Paramount Netflix deal. Drama.
That's right. How long is this going to go on for, I guess? Now we have
sense a movie.
7 days where, exactly, we have 7 days where Warner Brothers has opened it up in terms of having talks with Paramount Skydance. Paramount has sort of hinted at offering $1 above their original offer, so putting it at about $31 per share. They've also said that this isn't the final offer. It sounds like there is room for negotiations. So there are 7 days. What could happen, we still don't know. The board still seems to indicate that they do prefer the Netflix deal, but anything can happen in 7 days. You could either see Paramount leave it at $31 per share. You could see Paramount announce an even higher offer. You could see Netflix come in and also make a bigger offer. That could be a bit of a bidding war. All of this is essentially, in place to wait and see what happens. March 20th is the deadline for people to vote on the Warner Brothers and Netflix deals. So there's still a lot of time if you think about it. And like you said, maybe we could get to episode 5,000 with this entire situation.
I plan to binge watch this when it's all over. Divya, thank you very much for joining us today. Bloomberg's Divya Balji. Still ahead, we'll take a look at some of the notable analyst calls and recommendations moving the markets, including an upgrade for Chorus Aviation. Well, let's take a look at some of the notable analyst calls and recommendations for this morning. Scotiabank has maintained a positive outlook on Chorus Aviation, raising it to a sector outperform on the company's growth prospects. Raymond James downgraded Air Canada to market perform from outperform. The analyst saying the company's potential upside to consensus estimates in the near term is counterbalanced with concern over elevated capacity growth targets for 2027. Enbridge has been cut to hold at Jefferies. The downgrade is due to valuation concerns following a 12% rise in share price year to date and a re-rating of the stock to its highest multiple since 2022. A boost for EV buyers. Federal rebates are back for cars assembled in Canada and countries with free trade agreements. CTV's John Venevali Rao is at the Canadian International Auto Show and has more on why the relaunch is refueling controversy.
At Canada's biggest auto show this year, a lot of the focus has been on electric vehicles.
I think personally, my next vehicle will be an electric.
With automakers plugging their latest models, hoping the return of the federal rebate will rev up a bit of a sputtering market.
Every little bit helps. I'm not going to go play it, that's for sure.
After a year-long pause, anyone buying or leasing an EV as of today can get a $5,000 rebate or $2,500 if it's a plug-in hybrid. The program only applies to vehicles costing less than $50,000 unless they're made in Canada. Some think that's too low given how expensive EVs tend to be, though the number of vehicles in that price range has rapidly increased, with Transport Canada now listing more than 70 on a website. Now, while Ottawa and Beijing recently reached a deal to lower the tariffs on nearly 50,000 made-in-China EVs, none of those will qualify for the subsidy. Automakers are hoping the resumption of the rebate will put EV sales back on the road to growth. They fell from 15% of vehicle purchases in 2024 to about 9% last year.
So we're actually anticipating it to actually come back up now that the incentives are back, essentially.
Still, some potential buyers say they remain reluctant, concerned about the number of charging stations, particularly in rural areas. And some remain anxious about the range of EVs.
Just the range in the winter time. They tend to be like 20, 30% less.
But many told us despite such concerns, they are open to buying one.
We'll see where it goes. But yeah, definitely looking into it.
A subsidy proponents hope will drive more demand. John Benavelli-Rouse, CTV News, Toronto.
When we come back, Martin Cobb will take your questions on First Call. Time for First Call, and that honor goes to Anita from Markham. Anita, how are you?
Good morning. Thank you so much for taking my call. My question is on WSP Global. Do you see a lot of growth in this company? The price has come down a lot recently. And could I please have a street consensus on this too, please? I'll hang up and listen to you. Thank you.
Yes, hi, Anita. WSP, professional engineering services company, has been on my reserves list, my watch list, if you want to put it that way, for a Canadian dividend growth strategy for quite a few years now, and I've just struggled with the valuation. The business hasn't changed. The share price is telling you that maybe it has, but it's really starting to get into interesting territory. Nothing really has changed. We live in a world where you'll always require more engineering studies, environmental studies, safety studies, structural studies. They're so well positioned for that. The market has thrown a wobbly, not anything to do stock specific, but because of fears over X, Y, and Z to do with AI, as we've talked about. I think WSP is looking pretty interesting. I put it into that bucket of stuff that may well be worth picking up at this time, given the fears in the market.
Yeah, just taking a look at the consensus to Martin. 13 buys, 1 hold, 0 sells right now for it. All right, let's move on to Maggie. And this email says, please help me evaluate Oracle as an investment. Would you buy it at current levels? And what is the forecast for the end of 2026?
What a year. I mean, 6 months for Oracle. Remember last summer, the announcement about their forward-looking order book, and everyone got very excited, and the shares, as you can see, took off, and then they've retraced to a large extent, even more than they took off. I'm not a fan. The reason being is Oracle picks up the business that AWS for Amazon, Azure for Microsoft, or Google Cloud doesn't pick up. So they're the kind of second derivative almost of the capacity for hyperscalers, AI demand. And their customer exposure is very concentrated. So I just don't like the business exposure there. Fears over just slowing spend. I'd much prefer to own something like an AWS, Amazon, or Google, through Alphabet, or Azure through Microsoft, which we do. So I just feel they're in a position where if things go extremely well, they'll do pretty well, but they're much less defensive than some of the others. The valuation is down about 20 times this year's earnings, but you're buying Amazon today on 25 times. All right.
Actually, we have a question about Amazon coming up, but we want to get to this one from Rich, and it says, ask Martin about Royal Bank, please.
We like Royal Bank. We own Royal Bank, have done since day one of launching a Canadian strategy. It is the best bank in Canada, absolutely, in terms of returns on equity, growth rates, the way it's run, future outlook, ticks all the boxes. The only thing I would say is the valuation today is up there. It's over we're around about 2.25 times prospective book value, which is a little bit rich. It'll burn that off over time as it continues to grow. So we like Royal Bank. Just wouldn't be necessarily our top pick in terms of Canadian banks today. You can buy something like a TD or even a CIBC at a nice discount to Royal Bank. Not quite as good a business, but maybe the gap is a little bit excessive in Royal Bank's favour today. So still like it for the long term, though.
What would you like to see that number down to?
Oh, I'm Scottish. I'm cheap. So I would say Royal Bank, if we can do Gordon growth model here, Roger. I don't think we want to get into that, but should command a multiple of 2 times, maybe a smidgen over 2 times book value. But at 2.3 today, it's a little bit excessive, but not much.
All right. Next up, an email from Mike. What does your guest think of Thomson Reuters for the future?
This is another one that I would throw into the bucket of, this is interesting. It's been hit very hard. Obviously, fears Anthropic coming out with the legal AI kind of tool that is going to arguably eat their business. I put this in one I'm doing some work on, but I'm less, I feel their business is less resilient. The repository of legal information is much easier to be assimilated or searched by AI tools than something like we're talking about Adobe or we're talking about TMX. So whilst the valuation has come down a long way, now trading on a market multiple and historically it's traded on maybe twice a market multiple, I do think that the AI threat is greater with Thomson Reuters than it is with some others. So it's not the one I'm spending most of my time looking at today. I maybe keep my eye on it, but this one could suffer. I think its business has more potential to suffer from AI tools becoming embedded because it's more of a, less, ability, more ability for customers to switch and move to newer products than maybe some other companies.
All right, we've got about 30 seconds or so. I want to get this last email from Corey. His question is, let's get your view on Amazon.
25 times prospective earnings this year. When was ever you could buy Amazon on that multiple? Yes, scary. They're spending $200 billion in terms of capex this year, which is compared to maybe $125 billion anticipated. That is, however, in their own hands. They could dial that back to some extent. So Amazon, long-term view, pick it up here, absolutely.
It's one to grab, is it?
Yep.
All right, we'll wrap it up there. Martin, thanks as always for joining us. Always appreciate it.
Thanks, Roger. A pleasure.
All right, that is it for us here on The Street. Martin Cobb was our guest joining us today. Of course, from Lawrence Steinberg Wealth Management, he is the Senior VP of Equities there. Trading gets underway in just over 30 minutes from now, and the Open's coming up next.